All right, good morning, everybody. Just do a quick sound check. I assume everybody can hear me. If you can, that would be great. If you could just type in to the chat box there, so I know that I'm getting through to everybody. And let me get my chart kind of set up here. Pretty much got it the way I want it. I think based on the price action we have this morning, I'm going to label that as such. But let me just okay, cool. Everybody can hear me. Again, welcome. My name is Dave Floyd with Aspen Trading Group. I appreciate everybody taking the time out of their day to join me here today. Obviously, 2016 has been a really good year from a trading perspective. 2015, as we all know, was kind of low volatility, kind of a grinding market nature. 2016 has been anything but, and I think literally, as of today, or maybe in the next day or so, I think we're on the verge of another move lower. The wave count that I'm following, and I'm kind of basing everything, largely speaking, not only for my FX trading, but also for my equity / options trading, basing it mainly on the S&Ps, because as the S&Ps go, so do the related asset classes. So one of the things that I spend a great deal of time with on a day-to-day basis is the S&Ps. I need to get a handle on where they're going. And I think up until yesterday, I was still leaving open the possibility that we might rally up towards the 1980 level. That was certainly possible. But I think with this reversal right here over the last few hours, I think the 1938 level, which I also had deemed as a near-term resistance target, I think this should very well mark the end of this wave 4 completion. Now, for me as a trader, the approach that I take is that I'm usually looking for evidence that my forecast is actually coming to play out. This is good early indication. This is a good early indication. I'm going to drop this down to an hourly chart now that you understand what I'm driving at here. This initial move lower is certainly a good sign that suggests that the S&Ps are about to resume the downtrend. And actually, let me take a step back just for a second, because it's one thing to say, well, hey, it looks like the S&Ps are going to roll over. It's completely another thing to say, well, where are they likely to go to? If this wave count is correct, and I do believe it is, and I do believe the macro backdrop is consistent with lower levels in the S&Ps, there should be little doubt that we should head down towards the 1757 level. So that's almost 200 S&P points away. It's about 170 S&P points away at this point. And that is certainly substantial room, not only to be short select equities or indices, but also to position yourself in the FX market, because there's going to be certain FX pairs and or crosses that are going to be subject to moving lower in tandem with the weak S&Ps. So my initial target on the S&Ps, and it could take a few weeks to play out, would be down towards 1757. However, the one thing I want to be very clear on, or certain of, I should say, is that this right here, this is not enough of a move yet to suggest that we're starting to move lower. If I need to go down to, let's say, a 15-minute time frame, I can count 5 waves off the high here. Certainly a choppy correction. This is certainly looking impulsive. I'm going to want to make sure that from an Elliott wave perspective, this move that's developing lower really starts to gain a little strength. I'm going to want to see some impulsive price action. Does that mean I'll miss the absolute top? Yeah, sure does, but I don't really care, because I'm not interested in picking tops or bottoms. That's a fool's game, and you can try to do that all the time. You're going to lose a lot, and then when you do have a winner, yes, it'll be a big winner, but that's assuming you have the nerves to stay on, because you've been so beaten up in the last few trades. So we've got plenty of downside. Like I said, 1757. If I give up 10 or 12 S&P points because I want to be certain, or at least have higher conviction that I'm right, well, then so be it. So this is what I'm going to be focused on, especially for today. We've come out of the gate weak today. S&Ps are down almost 1%, well, about 0.8. They're at 1920. We could start, grinding lower here. we're going to have some very interesting trading opportunities. And I think the area that I'm focused on, at least I have been for the last few weeks, or not last few weeks, last few days, is if this S&P forecast plays out, which it appears as though it is, I'm going to be looking at, my main focus is going to be on the Kiwi yen. I think that given the way the yen crosses trade in a weak stock market environment, I think Kiwi yen is a great possible short setup here. We've been chopping sideways for a couple of weeks now, or maybe about a week. I'd like to see this level taken out, the 74.38, 73.60. Again, same thing that I'm looking for, though, is that I'm looking for evidence that prices are moving lower in an impulsive manner. Right now, this is not an impulsive manner. So what this could very well be is that wave 2 is still not complete. Maybe it's complete here, but it's certainly not complete back here, because this is not the beginning of a wave 3. It's too sideways, too choppy. So I would probably, for the time being, move that over. It was certainly tempting to get short Kiwi yen over the last day or so as prices rallied up into this upper end of the trading range. But again, that's like flipping a coin. Again, unless the S&Ps roll over, Kiwi yen will not roll over. So you can take a lot of the subjectivity out of your trading by being very objective about how you measure and gauge whether or not a move has any legs, so to speak, or if it's just kind of noise and choppy price action in between transitions higher and then transitions lower, or I guess what you would probably call corrections. There was just a question mark here in there from one of the participants. I don't know if that question mark was directed at me, but one of the things that I want to make absolutely sure of is that if there are any questions along the way, I want to make sure that you stop and ask me, because I want to make sure everybody understands what I'm talking about, because each successive chart and conversation is going to build upon one another. So I want to make sure everybody's clear. So Felix the Cat, you typed in a question mark. If you have a question, feel free to type it in. I want to make sure everything's addressed. And pardon me with a little bit of getting over a flu here over the last week, so I've got some lingering coughing and whatnot, so I apologize. I have a question in here about what's my view on the Nikkei. I don't follow the Nikkei, so unfortunately I can't really help you there. What I would say is that I'm bearish overall global markets. Therefore, if the S&Ps are moving down, the Nikkei is going to move down as well. So I don't have specific wave counts or forecasts on the Nikkei. But I would say that I would be bearish the Nikkei just based on what I see in other global indices. A really good question here from Steven. It says, do you need to understand all this economic stuff to be successful in Forex, or is just being a good technical trader adequate? The answer is I don't, and this is just my opinion, but I actually think the facts will bear this out. I think any trader who relies upon one approach only, whether it be solely technical, solely fundamental, I think is at a disadvantage. I think you have to combine various disciplines, a little bit of fundamental analysis on top of your technical analysis, or maybe it's a little bit of technicals on top of your fundamentals. Find that happy balance. For me, my general premise obviously is geared towards technicals, but my wave counts always reflect the economic realities that are happening at any given point in time. Too often people try to put their opinions into their wave counts rather than having their wave counts match what's happening in the market. So I do think it's helpful. You don't have to become a super expert at macroeconomics, but I think it really helps to have a good understanding of what's happening in the global business cycle so that it adds conviction to your trade. Let's face it, technical analysis is simply a reflection of what's happening in terms of prices, but it's a little bit, it's kind of one step removed. It's kind of hard to have a conversation with someone about, well, I'm selling this 77 level because it's resistance. That's a lot different than saying, I'm going to sell this resistance level because I still think the fundamental outlook is for a weaker economy, therefore weaker stock markets, and therefore that means stronger yen, weaker yen crosses. Therefore now that resistance level in, let's say, Kiwi yen at 79, let's say, has a story behind it as opposed to just some inanimate point on a chart. Does that make sense? Question here regarding pound New Zealand. I have it up here as a quote. I don't have a good wave count and or forecast on it. So pardon me, it's not something that I'm tracking right now. So I really couldn't offer you, any real good insight, quite frankly. I think I understand your question, Pan, but I'm not completely clear. It says, where do you get that info to have that confidence to say that? I think I know what you're angling at there, but if you could be a little bit more specific, I'd be happy to address that. And these are all really good questions. Again, I'm not familiar with all of the different speakers that come into FX Street and talk on a day-to-day basis. I know some of them, some of these people I've known for many years. I don't know everybody that comes in on a day-to-day basis, and I don't necessarily know their styles. But the one thing I do see in the industry, I'm not, and just in kind of looking around over the years and my periodic interaction with competitors and other traders and whatnot, is that all too often people approach the market from a very one-dimensional perspective. And what I mean by that is they're either just looking at the chart pattern or they're just looking at some sort of a fundamental piece of data. Doesn't mean that that won't work, but I think combining various disciplines, or what you would typically call intermarket analysis, can really, really enhance your effectiveness as a trader. I'll give you a simple example. If the dollar, let's just say you're looking at the euro. Let's pull up the euro chart, and I haven't updated my wave count here. I have some labels here, but I did it on my other computer earlier, so I haven't updated them here, but that's okay. But let me do a simple test for everybody here, and then Pan, I'm going to come back and address your question, and I appreciate the clarification. If you wanted to get long the euro right here, and I also at the same time, well, actually, let's just assume that you wanted to get long the euro because you thought that the 110 level was going to be killer support. And you showed me your chart, and I was like, oh, okay, yeah, makes sense. Totally get it. You could go with that particular trade setup, and based on the way you analyze just this chart, you might be right or you might be completely wrong. And I know that sounds like a really stupid comment, but can anybody tell me what one other related market or index you would absolutely have to consider before you made a trade on the euro? Because I think if you're not asking yourself those types of questions before each trade, I think you're at a disadvantage. It's just my professional opinion, but I've been at this for 20 years. I sell my research and my forecasts for a living, and I also manage money in the currency market for a living. So I think it's fair to say that I kind of know what I'm doing here. I wouldn't be employed, or I wouldn't have the business that I have if I wasn't good at this on some level. Doesn't mean I have all the right answers or my way is the only way, but I think what I'm dispensing here on a weekly basis is information that has worked for me and information that I have uncovered and, discovered, I guess, for lack of a better word, through, 20 plus years of doing this. All right, Pan got the answer right, the dollar index. And that's absolutely right. If you're ready to get long the euro here because you think that 110 level, that one spot 10 level is good support, you damn well better make sure that the dollar index is about to move lower, because the two of them are inversely correlated. And I'll make it real simple for everybody in here. I'll just show you a visual. And there you have it. Unless the dollar index is moving lower, the euro is not moving higher. It's as simple as that. Now you can take that same logic, and this is the simplest, or I should say the easiest of the logic to consider if you're trading the euro, but you can apply that same thought process to a variety of other markets. So let's go back to Kiwi yen. I think everybody in here would agree that when the markets are weak, or what people would call a risk-off market, the Japanese yen tends to strengthen. Therefore, and if you add another element to that, if you look at currencies like the Aussie dollar and the Kiwi dollar, and certainly the Euro Kiwi, or I'm sorry, let me take that back. When the markets are weak, the Aussie dollar and the Kiwi dollar also tend to be weak as well. So if the yen is going to be strong during market turmoil and weak markets, and the Aussie and Kiwi dollar also tend to be weak, it would seem logical that Aussie yen and Kiwi yen would be good short candidates, because they both come together with a common theme of weaker / risk-off type markets. Now, that correlation is not always perfect. No correlations are. They change and they ebb and flow over time. But by and large, weak S&Ps will equal weak yen crosses pretty much across the board. I decided to trade Kiwi yen because Kiwi, relative to Aussie dollar, has been the weakest in this recent rally in the stock market. Yes, Aussie dollars rallied. Yes, Kiwi dollars rallied, but Kiwi has lagged. So I'd rather go with the laggard of the two, pair it up with the yen, which has been strong or will be strong when markets roll over. Hence, Kiwi yen is the one that I've chosen to focus on. As I noted earlier, though, we've got a lot of sideways chop here, and we don't really have any discernible break up or down. My bet is that prices will break lower. So therefore, I'm going to be looking for evidence, or I'm going to be looking to get short here. I might do something as simple as, selling a break of this low, 74.17 or 74.15, whatever that number is. Or, if I can count 5 waves out, let's say on a 15-minute chart, I might sell that next rally. But I got to make sure that not only this is moving lower, but I got to make sure the S&Ps are moving lower. As of right now, it looks as though they've put in a top. This is by no means convincing enough for me yet. And that's part of the reason I don't make a tremendous amount of trades on a month-to-month basis, maybe 4 to 6 trades a month. That's okay. We trade for quality, not quantity, and we trade not to be entertained. We trade to make money. Another big misconception out there, that you always have to be in the market and that there's something going on under every rock if you look under it. Big big mistake. Quickest way to drain your trading account to zero. So Stephen, going back to your question, it said, do you need to understand all this economic stuff? My answer would be, yeah, I think you have to have your pulse or your finger on the pulse of what's happening on a fundamental basis. It's not absolutely required, but I think you would find it a great benefit. Now, one of the other things I do that you probably are, or maybe you're not aware of, is I do focus on the equity market as well, mainly through the use of options and individual ETFs. And one of the trades that I've been layering into over the last week or so is a short in IWM, which is the ETF that is the represents the Russell 2000, and also a short in Goldman Sachs. I am of the opinion that some of the rumblings we saw from Barclays Bank last week about, it might not have been last week, but the week before, about possible, or no, Deutsche Bank, it was Deutsche Bank, maybe some liquidity issues, restating earnings, that just puts up on my radar images of previous market downturns, whether it be back in 08 when they said, oh, subprime's contained, and then subprime started going, belly up, and everybody still said, oh, it's contained. And of course, these people are all morons. They're the same talking heads that are on TV all the time saying we're always going to go higher. You know who these people are, and they're always wrong. So from a fundamental perspective, I do think the global economy is weakening. I do think there might be some fallout to the lower oil prices in terms of the bonds that have been issued by some of these oil drillers and oil service providers. And I think there could be default issues that could come back and hurt the banks. Negative interest rates in Europe, that is not a good thing. That is going to crush the margins of the banks. And as a result, it's certainly possible we could see some dislocations in the banking sector. So for me, I was like, well, Goldman Sachs, they stand to have some risk as a result of that, probably some counterparty risk. I'm sure they've underwritten and probably own some of the bonds that are in the oil patch. Again, it's like a cockroach. It's not going to be contained to one bank. If Deutsche is having problems, Morgan's having problems, Goldman, Citi, Bank of America. Could I have chosen a different bank? Maybe let's say a weaker player in the arena, maybe a Bank of America or something, perhaps. But I chose to go with Goldman because I do think that you'll get a really swift move if, in fact, that premise plays out. So what I did last week is I started building a short position in Goldman Sachs. And here's my chart of Goldman Sachs, just so you know where I'm coming from here. As prices rallied up into this level last week, and it looked as though the S&Ps were starting to top out around the 1920, 1940 level, I put on a bear put spread in Goldman Sachs. And it's modestly in the money right now. But basically, I'm betting on the direction of Goldman Sachs moving lower. Now, anybody who's familiar with options knows that the drawback of having a spread is that if for some reason Goldman dropped from where it is right now, 144 to let's say 120 in the matter of a day or two, owning an outright put would have been the most advantageous trade to have on. But with the spread, as long as I get the direction correct and prices move in that direction in a reasonable time frame, I have less risk of that option expiring, either worthless or worth less than what I paid for it. So my time decay is mitigated a little bit. And I did the same exact thing with IWM. Sold into this rally here, and again, expecting prices to roll over. I'm only modestly in the money on these trades, so it's still too early to know whether I'm correct. But I'm just taking a look off to the side here at my positions on my Thinkorswim account. Just give me a second here. Yeah, my Goldman Sachs positions are modestly in the money, and I'm actually still down money in the IWM put spread. But again, if this sell-off that I'm seeing starts to gain a little traction, those will quickly go into the money and it will be no big deal. And neither of these expire until April anyway, so I still have time to go. Now, in terms of, let's say, the dollar index, for those of you that might be interested in trading the euro, I think we're going to see continued higher levels in the dollar index. This is what I'm seeing overall. I'm just going to step back and show you the daily chart. I think we're in the midst of a triangle here, but I do think we've got a little bit more upside, at least towards 98.25. And if we take that back to, let's say, a 4-hour chart, this is how I'm arriving at it. I think we've completed wave A. Looks as though we've completed wave B. Therefore, wave C probably likely to terminate around 98.42, 100% the distance of wave A. And then 100.12, if we get up that high, is also another relevant Fibonacci level. But bottom line is, it looks as though the dollar index is going to continue higher, probably trading up to 98.25, maybe even up to 100. But bottom line, from where we are right now, dollar index has room to run, especially if it takes out this yesterday's high at the 97.60 level. As a result, based on what we've already talked about, we'll see the euro trade lower, probably down into the 109 level, possibly down into 108. That's certainly possible, because if the dollar index is in a triangle, you can be assured that the euro's in a triangle. So I see the euro going lower as well. It's a question of, do you want to short-term trade it as it moves lower, or do you want to have a position on and let it ride? And that's, of course, a personal preference. But I think the directional call that I have is correct. Lower euro, higher dollar index. And I also think that the S&Ps will continue lower, and that will drive Kiwi yen lower, as well as my positions in Goldman Sachs in IWM. So that's kind of where I see my trading opportunities right now, and that's plenty for me to keep my eyes on and manage effectively. That's kind of how I approach the market. I wait quite patiently. I've been waiting for ever since this S&P rally got underway. Back off that Feb 10th high, I've just been waiting patiently for prices to begin to stall out, and they're starting to do that now. So I haven't really made any trades other than starting to build the Goldman Sachs and IWM position. I will be looking to get short Kiwi yen if the trade setup reveals itself. So what I want to do is just kind of go through questions and whatnot, because that's how I'm viewing the next several days. That's how I'm going to deploy my capital. And I'm more than happy to talk to anybody in here about questions that they may have, or if they want some clarification on how I'm approaching this. Question here is, why am I trading IWM and not the futures? I just don't trade the futures market. I prefer to express these positions or these views and forecasts through the options market, and I do that through options on ETFs or stocks, not options on futures. So personal preference, but again, the outcome will be the same. If you're short the Russell 2000 futures and my forecast is correct, you're going to make money. So I don't think it really makes a whole lot of difference. It's where your comfort level is. Okay. The question is, no, I actually had it on mute, Pan, just while I was waiting for questions to come in. I was typing a few things off to the side. The question here is, when the S&P is down, do yen pairs strengthen? No, the yen strengthens, but yen pairs go lower. So dollar yen will go lower, euro yen will go lower, Aussie yen, Kiwi yen. So just think of risk off equals yen strength, which obviously means yen pairs moving lower. When we have a losing month, what is the drawdown? Well, the drawdown is always going to be dependent upon your account size and how large or how small you trade. If you want to be a little bit more specific, I can kind of address that, but it's a question I get a lot, and it's a question that you can't really answer because your drawdown is going to be dependent upon your risk exposure on a per trade basis. You know, I might, let's say I lose 100 pips in a given month, and I'm trading standard lots on a $10,000 account. Well, I'm going to be down $1,000. If you're trading two standard lots on that same $10,000 account, you're going to be down $2,000 or 20%. So same exact trades, completely different drawdown. So there's no way to answer what would the drawdown be. It's all dependent upon how you position size. Question here is, what is my overall market approach? My market approach is pretty straightforward. I do all of my technical analysis within the context of Elliott Wave and Fibonacci. And then on top of that, I overlay what I see is happening in the macro environment. If I see that there's evidence of the economy slowing, strengthening, whatever it may be, I'm factoring that in. And that doesn't change on a day-to-day basis. Those are generally themes that take months and months to continue to play out. But towards the end of 2015, my view became bearish, and rightfully so. I think anybody who is being objective about looking at data would have to say, at the very least, this market goes sideways. Worst case is it goes down. But those are the only two outcomes I personally see. I don't see how we can go to new highs from here. We don't have the backdrop from an economic standpoint right now that would suggest higher equity prices. And therefore, if we're not going to have higher equity prices, that's going to impact how I not only trade equities, but also FX as well. So does that make sense, Felix? It's one of the things that I do in terms of the research in the forecast that I provide clients each day. What I intentionally try to do is be as specific as I can as to why I'm doing what I'm doing. There's no mystery as to why I'm getting short or why I'm getting long. I explain it. There's no top secret algorithm or proprietary methodology that I have here. I think that's all a bunch of smoke and mirrors anyways. That's just my opinion. There's only so much data out there. You make of the data what you make of it, and that usually comes from years of experience. So what I do, and what I think I do pretty well, is that I say, hey, here's why we're doing this, and here are the bullet pointed reasons. And what that does is not only does it give the client the ability to take the trade, and over time we've had a very good track record, and you can see the track record not only for our stocks and give me a second here. You can see the track record for our stocks, service as well as our FX service on our website. And I'll just put those links in here real quick. But by not only getting the trade, you're also getting educated at the same time on why the trade's being made. So my goal is that through the, over weeks and months, you actually understand my thought process. It doesn't mean you have to trade like me, but I can at least give you a foundation to trade from, or I can give you a few techniques that you might use with what you're already doing. And that might just make the difference. It might be like, oh, I added that particular approach in. Let's say I've been a technical trader only, and now I listen to what Dave was saying, and I kind of understand what he's saying about the fundamental stuff. And you might add that in, and you might find that, wow, that made a big difference in terms of the timing of my entries. And as a result, your profitability and your win-loss ratio improved. So that's the goal of what I do. And then, of course, for clients that are, let's say, not full-time traders and maybe a little preoccupied during the day with life, they can have those same exact trades that we issue placed directly into their brokerage account through the trade copier program that we run. So I've got you covered on both fronts, on both the equity and the FX side. We don't manage money on the equity side yet. That's probably something we will do in the next, I don't know, probably year or two. But right now our main focus is building out the FX money management business. And we've been very fortunate. We've had a good 2-year track record thus far. We were ranked top, the number 5 currency fund by Barclay Hedge for 2015. So that was pretty damn good. And we just recently got a $5 million allocation from an investor. So that's our biggest allocation year to date from one individual, or one entity, I should say. So that's what our focus is. So we kind of I put my money where my mouth is. I'm just not offering trading education, because if you're not managing money, but you're teaching people how to trade, there's a little bit of a disconnect there, because if you're not publishing your results and making money for clients, you might not want to be teaching other people how to trade. Just my 2 cents. So, well, you can go to the website. There are losing months. I think our max drawdown, on our trade copier, it's right on the website there. I'll put the link in here. Give me 2 seconds. And the data that you'll see on that particular page is the drawdown using no leverage, 0 leverage. So our returns are done without using any of the leverage afforded to us in the FX markets, which to me makes the results even more, I don't know, interesting. Interesting is not the right word. I don't know, I guess robust. Most of our clients will typically use 2 to 3, maybe 4 times leverage on a per trade basis. So any returns that you see on the website there, multiply those by 2, 3, or 4, whatever you decided to do on a leverage basis. So what I mean by leverage is, let's say you had a $10,000 account and you wanted to trade each signal at 3 times leverage. You'd be entering 3 mini lots or $30,000 on a per trade basis. And trading at 3 mini lots on a $10,000 account is not exactly, high risk. I mean, if it's your last $10,000 to your name, maybe that may not make sense. But if it's part of your trading account, 3 mini lots is not an outrageous number. So whatever those numbers are on the website there, for instance, in 2014, we're up 16%. So and that was not with no leverage. So if you did 2 times leverage, you're trading, you return 32%, et cetera, et cetera. I don't really have a good definition for market sentiment because I don't follow it too closely, other than what I would think the standard textbook definition is, which is the amount of bullishness or bearishness in a market. How you measure that, there's a variety of ways to do that. But I don't know a whole lot about it, Felix, so I'm probably not the best person to give you an answer that would probably serve you in the best way possible. Question here about, do I think the S&Ps can go higher because they've, kind of put in a double bottom here? And I think I know exactly what's happening, or what this gentleman's referring to. Yeah, I mean, it's certainly possible, but again, technically, yes, I see what you would be saying there, but I look at this and go, why on earth would the market rally to new highs given the state of the economy? The economy is not exactly in the tank, but it's not as robust as it was, let's say, 6 months ago when prices were at 2120. So I look at that, and I also look at a variety of other things that would say this is just a correction. We've had a sharp move down. This is simply a correction within this downtrend. I don't think this rally will go on too much longer. So yes, is it possible we put in a double bottom? Sure, but I really think that's way too simplistic of a way to look at it. I think you got to look at a variety of other factors. It's hard to know which currency is going to be the best performer. I would say that if my forecast for lower levels in the S&Ps, at least for the next couple of months, I'm not going to go to the end of the year because that's way too far to go out. A lot can change. But I would say over the next month or two, given that I think we're going to see continued weakness in the S&Ps, I would think that yen is going to be the strongest of the currencies because that's going to move in tandem with the S&Ps. So I would say shorts in the yen crosses or shorts in dollar yen should be the most robust places to be if the S&Ps remain weak. I think that's the easiest way to look at it, and I wouldn't go much beyond 2 months at this point. I'll reevaluate at the end. And the reason I say that is that I do think if the markets were to get really weak in here, I really do think there's a chance that the Fed would come in with yet some other ridiculous program, call it QE4 or whatever the hell they want to call it, and that would be the fuel to push markets higher. That I could see happening. Everybody's drunk on easy money and they think that's the elixir to solve everything. Of course it doesn't. It's done nothing but create a lot of misallocated capital, but that's a topic for a different week. So that's why I'm not really too keen on going much beyond a month or two from now, because I really do think if the market were to get weak enough, the Fed would come in and try to create some new nonsense program that they come up with. And then if that's the case, if we get down to around that 1750 level in the S&Ps, you can be pretty sure I'm going to be pretty flat in terms of being short. I might even have some long exposure at that time, just in the event the Fed does do something stupid like that. And based on that, that is all I have for today. I really do appreciate everybody's questions today. The more questions we have, the better. Makes for a more robust dialogue, allows for not only you folks to learn, but for me to learn as well, because sometimes by getting questions, frames things in a different way and gets me to think about something differently, or might bring up something I hadn't considered. So I greatly appreciate that. And again, as always, thanks to Mauricio and Adinda over at FX Street, as well as everybody at FX Street. Great group of folks over there. I greatly appreciate them having me here each week. And I will be back next Tuesday. So have a great trading week, everybody, and we'll talk to you then.